First of all, this freaks me out. I think this is one of the freakiest developments of AI.
Hi, everyone, and welcome to a new episode of the VC React podcast. Every week, we bring you insights and reactions from top VCs, LPs, and angel investors reacting to the latest news on startups, VCs, and investment rounds. Let's jump into it with our amazing guests for today: Cristina Bullon, principal at Incubayt Investments; Philipe Moura, founder and CEO at Vinci Ventures and president of FDC Angels; Sara Asad, a venture capitalist and ex-Endeavor, and my co-host Jamie Lane from FWDstart. In the video description, you can find more details on our guests, their LinkedIn profiles, and links to their companies' websites. Our weekly news are brought to you by FWDstart, a twice-weekly newsletter that breaks down what's happening in the MENA startup, VC, and tech space. Before we start talking about the news of the week, I want to tell you about OCTA, our new sponsor. OCTA is an AI-powered workflow automation platform that helps modern businesses collect payments faster, smarter, and without the back and forth. If you're a founder or a finance leader, you know that managing receivables requires 14 hours plus every single week. It's chasing corrections, negotiating payment terms, updating invoice details, and constantly following up with your clients.
OCTA automates the entire process, handling everything from invoice disputes to payment confirmations, so your team can focus on growth, not admin work. That's why more than 100 companies like Careem, Lean Technologies, and Algram trust OCTA to streamline accounts receivable. Check out OCTA at weareocta.com, that's WEAREOCTA.com, and experience the modern way to manage receivables.
Jamie, I know you're on vacation, and thank you so much for joining us today. You're joining us today from Japan, and Phil is joining us from Brazil, Cristina from Dubai, Sara and myself from Jordan. This is a truly international episode, right?
Oh, you bet it
Yes.
is. Absolutely. I am at least 6 pounds heavier than when I arrived. I've had more ramen than I care to admit. I've had more sushi than I care to admit. But hey, look, these are the perks. But couldn't miss. I mean, this is to give the people what they want, Ahmed. So I had to be here. I couldn't deprive them of my presence. So
Well, thank you for joining us, even when you're on vacation. So what's happening this week, Jamie? What's our first story?
Yeah. For a change, and we start with FinTech. We'll break it up. We never do that.
Okay.
Yeah, no, this is an interesting story as well. A company emerging from stealth, announcing a pre-seed and a seed round simultaneously. So this is Dubai-based ClearGrid. They have announced 10 million in pre-seed and seed funding, and they're aiming to modernize debt collection and recovery with AI-driven automation. So we have a 3.5 million pre-seed co-led by Raid Ventures and Beko Capital, and then a 6.5 seed round led by Nua and return for that round as well. It's pretty stacked cap table. Wide Ventures as well, Aramco's Venture Arm, KPW, Sharaka, 9 Yards, Endeavor, Wamda. I think we've probably had a guest from every one of the VCs who participated in this
We
preview.
did.
Yeah, we really have. And also some really interesting angels here as well. You've Amjad from Replit, Jason Gardner, Marqeta founder, Justin Khan, Twitch's co-founder. And look at a really interesting founding team as well. Mohammed Al-Zaben, previously co-founded Monchan, that was acquired by Careem back in 2022. In terms of how I suppose he came to the problem itself, something he actually encountered during his time managing corporate receivables at Monchan. And this led him to explore consumer collections could be reimagined with automation and AI. It's a pretty colossal problem as well, and for the most part, pretty antiquated, I guess, in terms of how it's handled regionally and globally as well. I think for the most part. In terms of what the company does, we may be honing in on that a small bit as well. Essentially, it provides lenders with AI-powered debt resolution tools, so automating collections and improving the borrower experience as well. So integrates with banks, fintechs, and lenders via API, uses AI then to score repayment likelihood, predict borrower behavior, personalize engagement across multiple different communications channels. And look, they've had some really impressive uptake as well, especially considering they've been doing this in stealth. Obviously, generally, we see announcements and that leads to buzz and, can precipitate, I guess, more partnerships coming on board. But they've already signed 10 major fintech and banking clients in the UAE and are managing hundreds of millions in debt portfolios at present. So with this new funding, the plan is scaling operations. They're trying to double the engineering team and expand the platform. But really, really interesting startup.
It is indeed. With only 2 years, they managed to sign 10 big fintechs and banks. That's amazing. And they secured a relatively big pre-seed round, $3.5 million in pre-seed 2 years ago. They reached, according to the news, they reached initial profitability, let's say, and all before announcing, as you mentioned, Jamie. This is something we don't often see, right? Do you think this build quietly, launch big approach is a new playbook for fintech startups in MENA? How does this influence investors' confidence? And also, usually investors, they announce that, hey, we invested in this and that company. They add it to their portfolio page on the website. But for this company, I don't know, it seems that they didn't.
I am amazed at their numbers from coming directly from stealth. It's a problem that here in LATAM we've been addressing for many years, the issue of collection. So from a trends perspective, I think it's very interesting that, at least from my understanding, they seem to be aiming for being the first movers, right? They're aiming to capture this, and because probably they're coming from a second-time founder, right? So probably he had the connections, he had the confidence of investors at that early stage, which helped him secure those first deals. In most markets where I operate, I would find it very hard to break at this point, being stealth. But hey, kudos to them. I think it just goes to show how far and how much in need the market is for that type of solution. And we've seen some other competitors using AI for debt collection. If they manage to be the key players in MENA, I think they're going to hit it big.
Yeah, Cristina, would you wait 2 years to announce a new investment?
Well, it's strategically, and I think that they are resolving such a huge problem, right? This is not just chat box. This is operational transformation, and it's AI to predict repayment behavior, segment users, and even they have a personalized tone of voice. It's not about efficiency only, but it's like about doubling recovery rates with empathy in a way, right? So I think when you have such a obvious problem that you have experience, you get working, and that trumps everything else. If you look at the MENA debt collection, we are still in the 90s. The collections in MENA are very manual, they are fragmented, legally aggressive, and Cleargrid is introducing digitation and compliance, compassion in a way based on their models and what I've been looking at in one stock. So they are really a category creating play, not just a tech upgrade. So I think, they've made sure they had the numbers, the clients, and the model before saying anything, maybe as a way as well to protecting the model and what they were doing. But definitely, this is going to change how banks lend as well. If you look at it, recovery rates, confidence in the credit ratings, lowering the number and the percentage of non-performing loans will improve not only bank adequacy lending velocity, but it's going to reduce systematic risk. So very interesting what they're doing.
I love your comment about it being in the region, it being like sort of in the 90s, because this is the sort of leapfrogging that you go from a like a very, very pre-digital age, and you go straight to AI that basically creates a landslide, right? It's a landslide win. I'm bullish on AI, so I'm I do have that point of view. So I think whenever you can bring that, you should. But it's a great point.
There is a lack of liquidity in this market, I would say, and this is very interesting because not only for lenders, but also will translate into higher spending for SMEs. And that increased capital flow that the region needs, it's going to boost investors and institutional confidence. So if you can predict recoveries more accurately and reduce the defaults, then you're unlocking smart underwriting at the end of the day. So doesn't just clean up bad debt, it unlocks more credit for more people. And that's just really something that is needed and is also very exportable when you look at it, because from Africa to Asia. So I think the reason why they did not market the investment or what they were doing might go on those lines. I might be completely wrong. Again, we don't know, but I would understand if that were the case.
Sara, sometimes announcing the investment can help the company as a startup get some credibility in the market, and it sometimes opens doors for them, right? But they did it without announcing anything for 2 years.
I
What do you
think
think?
you touched on credibility here, and I think that's very important. And both Cristina and Philippe also, were mentioning timing. And I think taking it a few steps back, we really need to mention that this is a repeat founder. And I think from a venture capital perspective, especially in the Middle East nowadays, you're seeing a lot of VCs that are moving towards investing in repeat founders, founders that have had exits under their belt, more so than fresh founders. So we're not looking at growth companies, but we're looking at, repeat founders that have done this before. Because at the end of the day, there's much more less appetite in holding a hand of a founder and helping them scale as an investor, but much more, he knows what he's doing. If he or she needs something, they're going to reach out. So I think that is where probably Ahmad and the founders have also thought of timing. So first of all, they were able to raise before announcing anything. And we've seen many other founders that have done this as well. So maybe out of Jordan, Hamdi Tabah for Abwab. So Hamdi was ex-Uber. He was able to raise for Abwab before even launching or pre-revenues. So that's also very important. But I think with timing, I think Clear Grid's emergence couldn't have come at a better time, because over the past 2 years, I think the fintech ecosystem in the MENA region is being built out. So we're still developing infrastructure-based products rather than feature-based products or something that's great to have or that's going to make our life easier. It's more of we're making products that we need to make our life easier, right? And especially with like the emergence of products like buy now, pay later, digital payments, lending platforms. So I think the increase of all of these solutions and actually over the past 3 years being solidified, being proven that, consumers need this, companies need this. And I think they came in the right time is, okay, we have companies that are lending, everything is credit-based, consumers are loving this, it's accessible for everyone. So let's come in, bring in a solution that's, making these transactions much easier for them. So I think it couldn't have come at a better time. Definitely. And tapping into Saudi, I think, is also going to be something very strategic when it comes to valuations, and just to see how their valuation is going to double or triple simply from, entering the Saudi market.
You all mentioned how maybe the previous experience of the founder helped him in securing such a big pre-seed round. How easy is it would have been for Mohammed Zibin to raise if his previous company didn't succeed? How acceptable or forgiving are VCs in our region, or maybe in Brazil too, Phil, if the company didn't succeed?
Well, from my perspective, basically they earned or they paid for a really expensive MBA.
Yeah.
So it's kind of that investment that I'm willing to bet on you a second time because I trust that you're not going to make the same mistakes again. It's that sort of deal. I would say that you asked me specifically about Brazil. I would say VCs are not super forgiving here. from that perspective. But I've seen that time and time again in more developed markets such as the US. I would write it off as an MBA.
Yeah, I just wanted to also comment on what Philippe said, given that, VCs, if he had not been a repeat founder, I think what they also did was very smart. So I think their angel investors are much more strategic, probably, than their typical institutional VCs. So when you look at their different angel investors, like Amjad Mas'ad from Replit, I mean, his expertise alone building Replit has given clear grid that, tech credibility in a way. So we're going back to credibility in building these, scaling developer-centric platforms. So Amjad is sort of like a, back end, okay, your tech works. You have people like Jason Gardner, expertise in FinTech. Justin of Twitch, he's, known for building viral consumer tech products. So, bettering that experience for consumers and lenders. So I think the strategic investors, angel investors here might have also maybe pushed those typical venture capitalists to put in that tech.
I would say it's important as well to understand what went wrong the first time around, because you have so many things that do not depend on the founders, and that's a reality. You've got timing, I've seen companies where, you had a single founder and then that person had a horrific personal problem, or, and they just had to park everything, unfortunately, right? So there are circumstances that obviously are beyond how efficient or lean you are as a leader of that company. So I think when going back to investing in a not successful founder, as Philippe said, very expensive MBA, they probably learned a lot, right? I think that there is I don't want to call it leap of faith, but for lack of a better name for it, yeah, you give back to that founder as, I trust what you learn, and I trust that the second time around you would do better with the skills that you've acquired in your first enterprise.
Let me go to their website. It looks really great. If you scroll down this spider chart here. So what they created a model to assess the risk of the consumers, and they score them on the ability to repay, sentiment, income, proximity, behavior, responsiveness, and willingness. We always hear about companies using the word AI in their pitch deck just because it's a trend now. But it seems that they're actually benefiting from AI. It's a needed technology and they're solving a real problem. But my question is, what kind of data can they collect to come up with such a model, especially that these are consumers? I don't know if they have all of that data. Do they take that data from the bank or the fintech? Where does ethics can play a part here? They're learning a lot about this user, right? What do you think about all this as a consumer?
I have a lot of thoughts on that, and it's one of the things that really caught my eye when I was looking them preparing for today's call. Is as a starting point, I invest in a LATAM-based startup. It's a fantastic startup. They were pitching last night at Morgan Stanley, so they've got a lot of U.S. investors. They're doing super well, and what they do is they have developed their own AI algorithm to analyze your voice, and from your voice, they can tell your level of self-confidence, your level of stress. And while they have initially developed that to help companies be extremely more assertive, quicker, and overall better at making hiring decisions, you can use that tag for anything. Let's say you're going to fly a plane, or you're a doctor going into a surgery, and maybe if you just talk to the AI for 1 minute, the AI will be able to tell, no, you're not in tip-top performance, so you're not allowed to go into that surgery. Otherwise, I'm going to have to up my insurance premium or something like that. So those are scary good types of technology. I don't know if they at ClearGrid, if they built their own model, if they're using APIs from existing services. I'd be super interested to hear if it is. their own model. And before I go into your very specific question about how would I feel as a consumer, I think that this is a super powerful tool. And from an investment perspective, I would probably even value, if it's their own technology, I would probably even value this higher than I would value the FinTech component itself in my investment decision. Because from there, you can probably go to the step before you have to collect the debt, which is ensuring that lenders make more assertive lending decisions, right? And so you could actually ultimately reduce the premium or the risk that you price into your product. So it's a two-edged sword, right? Because from one hand, you'd be like, I would hate for this unknown algorithm to look at me and be like, yeah, here are all the ways that I can convince you to pay when I need to choose between paying my bank or paying my electricity bill or paying for my child's medicine, versus I would love to get better rates because I'm such a good payer. So, it really depends on how they use it.
I
And
love that.
AI
Yeah, you put it very nicely, Phil, because we don't have a credit score in Saudi or in Jordan like the US, right? So when there's a credit score, there is a clear standards and clear points that I can work on to enhance my credit score. But this algorithm, I don't know what they're using, what data they're using to score me. I mean, what?
On your point, Ahmad, I've seen it being used in some financial inclusion aspects of the fintech world, which is for those consumers that are probably out of reach for most financial services, as in you would have a horrible credit scoring if credit scoring exists in your country, or if it's not available, and I would never lend you money. However, this algorithm makes me see that even though you haven't paid your card for however many months, you always pay for your child's private school on time. So you're probably, if you're getting that money for X, Y, Z reason, then you're probably going to be a great payer. So for you, I'm going to make an exception. So the algorithm, even if you have no credit scoring available, is able to make those financial inclusion decisions for that. Sometimes it's life changing for a lot of people. So it's great tech in and of itself, and like most technologies, it depends on how we put them to use, right?
Yeah, I don't think it's so much the define element, but it's just a feature that will allow them to really build on the data and give a comprehensive analysis of this data to the bank so they can build their, risk models, and to as well develop those credit scoring capabilities that we don't have in the region. But instead of doing it through your credit cards, right, which is usually how it's done in the West, you are using all of this technology available to you to really give you more parameters and be able to pinpoint, as Philippe was saying, you might not be able to pay for this now, but you're paying for this other thing. Okay, how can we, ensure that you are going to pay for this loan, right? And as I understand, they also provide a flexible repayment solution. So that goes to say that it is not just as a punishment for the borrower, but a way for the lender to understand how they can get their money more effectively.
Yeah, Sarah, what do you think? I mean, I think we do now in Jordan, we have a common database that's shared by all the banks on how this person is, performing and repaying a loan. Do we? But we don't have a credit score
No,
system
we
yet.
don't. We still don't have a credit score system. And I think this also applies to many emerging markets across the globe. And I think it's predominantly because of this underdeveloped financial system in a way. And I think a lot of cultural behaviors also come in. So you have a lot of offline lending that happens. I can maybe speak about the Middle East. So you have a lot of offline lending, family lending, or crowdsourcing platforms, something called jam'iyat. So you have a lot of other formats that are being adopted here. And I think also, it's very still heavily reliant on micropayments and predominantly a cash economy, excluding the GCC. So when it comes to, I think, AI and what ClearGrid is doing, I think definitely predictive analysis and behavioral data is going to beat credit scores anytime, any day. And I think it can be the first step to sort of collecting and organizing and institutionalizing that financial data that's available in central banks or in different financial regulatory systems. And hopefully we see it span out to the region, right? So maybe similar to what the EU has done, where, the entire zone has some sort of stable credit system. And maybe we see it span out across the GCC or the region.
Well, Jamie, we're still in FinTech, but this time we're moving to Africa. What's happening in there?
Yeah, we are. It's fitting. Look, I think we've touched on the FinTech infrastructure side of things there slightly, and also, I guess, underserved financially from an emerging markets perspective. So, I mean, there's no larger sort of underserved market than Egypt, in particular as it pertains to this. So, look, really interesting seed stage deal here. Enza, they're actually Dubai based, but again, it's focused on SMEs in African context. They're a payments infrastructure startup, and they've just raised pretty large seed round, 6.75 million, co-led by Algebra Ventures, who have fantastic pedigree on the fintech side of things. Previously backed M&T Hallen, Connect Money recently, who also had a really large seed round, mentioned the 8 million seed round a couple of months back, and Kazna. And then you've Kona Capital as well, who have backed Kazna as well. So that's a deal that previously would have collaborated on. And they've also backed the sponsor of today's podcast as well, OCTA. So doing great work. But look, in terms of Enza, it was actually founded back in 2022 by Hani Fekri and Hamish Houston. They're both former senior execs at Network International. So it's one of the largest sort of payment processors across the Middle East and Africa. And essentially, I think what they're doing at Enza is a rethink of everything that they've built at Network, sort of a focus on what they felt was missing, which is real infrastructure for banks and fintechs across Africa. So not overly dissimilar to actually NIMCard on one level, which we discussed last week as well. So very, very similar. So in terms of what they do, provide infrastructure for both issuing and acceptance. So for banks and fintechs, it's card issuing, it's wallets, it's real-time payments. And then for SMEs and merchants, it's basically cost-efficient tools to accept payments both in person and online. So it integrates with your local and global card schemes, Visa, MasterCard, on the regional side, Afrigo, Visa, etc. And the idea is to give banks and fintechs a full stack, locally relevant infrastructure layer that they can use to serve the underserved without sort of high transaction costs and fragmented systems, and without sacrificing control as well. So look, the scale of the challenge is massive as well. There's over 60 million underserved SMEs across Africa. Obviously, huge swathes of the population remain underbanked or unbanked. And I suppose a lot of African banks, particularly, I think, have ceded market share to fintechs in recent years as well, especially in the SME segment in particular. So I guess it's kind of offering those banks, in many respects, kind of the infrastructure to kind of fight back to a certain degree, where you've seen kind of like your Flutterwaves or Fowry or PayMob and MoneyPoint have sort of gained an element of ascendancy. This is maybe providing those banks with the ability to try and make up some of that ground. But it's interesting that it's the second week in a row that infrastructure in particular has raised quite a significant amount of funding. So definitely a trend as far as this is concerned.
But Jamie, as you mentioned, there are many other companies trying to do the same thing, and they all kind of look the same because they're all trying to provide the payment solution and include every single type of payment. So my question to our guests today is, why did investors invest in this particular company? I know you might not be familiar with all the details of the company, but as an external investor, what was the most appealing aspects of this company that might trigger an investor to say, oh yeah, I want to invest in this company? Is it the big underserved SME market, or perhaps the experienced team, or the integrations they built?
I think it's also very important, before we dig into that question, we need to go a few steps back. And I usually don't like to speak about Africa as a whole, as a continent. And it's really important, especially with Africa, to dissect the market, because Northern Africa is very separate from Sub-Saharan, very separate from South. And when you look at all of the countries in Africa, each single country speaks a different language, has a different currency, has very different micro and macroeconomic characteristics, even if they're completely neighboring. So I think it's very important within this conversation specifically to really just try to separate so Northern Africa from Sub-Saharan and South. And it's just interesting to see that Enza is operating in Nigeria, Kenya, also South Africa, and then North Africa and Egypt. So maybe looking at it from an investor perspective, there must be something. So I'm not very familiar, but there must be something where they were able to sort of unite these markets across the continent in a single product and try to address different problems. So I think maybe that's something for Cristina and Philipe to build on as well.
When I read the article, this company excited me a lot because it's not that they are just enabling digital payments. They are laying down the financial rails for the local banks and fintechs to build on. So it's kind of Stripe meets M-Pesa for Africa, but with local contacts backed in, right? So it's empowering institutions. You were mentioning Flutterwave before. They are not really the same because Flutterwave and Paystack, they are focusing more on merchant acquisition, whilst ENSA operates at a wonderful intersection where the clients can be targeting merchants or consumers. So the go-to-market strategy flexes between B2B2B and B2B2C. So it's a very different play. And I think on top of that, they are playing on cross-regional arbitrage, leveraging the UAE capital and ecosystem strength while solving a very big problem in African markets. So it's very smart geographic position that they've got. And I think looking at the future, you will probably see this type of companies moving into SME lending, invoice finance, credit scoring, once they own the rails. And I think that's probably going back to your point, Sarah, how they've managed to be in such different locations. And I agree, one of the challenges in the execution is the country by country game. As you said, regulation, integration, FX volatility, this is not a scaling a SaaS. It's messy, it's high effort. So the question is, can they build local trust at speed? I guess we'll have to see. But so far it looks like, that financial rails they are building, they are fulfilling all the common problems that these countries have.
From my perspective, it seems that the region is in the infra build out phase, like LATAM was a few years ago. I can looking at LATAM, and if I can replicate some of the assumptions, there's going to be a lot of money, just a lot of money in that market. So I think it's a good bet. I think that fintech infra, but banking infra, payment infra is ultimately has to be local by nature, even if it is global in ambition. So I think to Christina's point, I think everyone wants to build their own Stripe, right, to solve for the local masses. One thing that caught my attention from their website, they talk about quote unquote complete confidence. And they mention, and I quote, our regulatory expertise across African markets is second to none. That's one of the big costs. And I think if they can make that happen, they have a lot of money to gain in arbitrage, indeed, as it was mentioned. And I totally second Sara's comment that they're already operating in very usually uncomparable markets, right? They're very different from each other. And the fact that they've managed to make it happen in those three might be, I think, in support of what they claim in their website. Confidence and regulatory expertise in Africa for Africa, quote unquote. We know Africa and we capitalize on the best global innovations, and so on. So while I, as an investor myself, am very skeptical of, let me put it this way, I came from payments, right? And it's a very tough nut to crack. Getting to the tiniest SMEs and making that infra available, it's a really hard nut to crack. And a lot of the biggest companies across payments and the financial services industry as a whole have been trying to crack that for many years. And hey, maybe it needs a local player, right? So at the very, if I'm slightly optimistic, it might mean a great call for consolidation in the future. or even for an M&A, right? They might be bought out, especially because they're going to have that penetration and that local understanding that a lot of the big players don't have. So I would, if I were to invest, I think that was your original question, right? I would go very thoroughly through over their assumptions. But if I'm able to validate them, hey, it's a place where I would put money with two closed eyes.
I love that we have people who are with and kind of against or skeptical on this. I love disagreements on this show. I always say that. Well, let me so ask about this. So maybe go back to you, Sara. You mentioned that it's from Egypt and they're working on different countries and they're trying to provide like a unified product for multiple countries. And we've seen many other companies from Egypt and from Morocco, maybe Tunisia, expanding to Africa, but not many from Saudi or in general from the GCC. What's really driving this? Why we're not seeing Saudi companies expanding to Africa? Is it Saudi market is too big already and it's big enough for them, or is just proximity or something other than that in play?
I think when it comes to Saudi, it's timing. I think at the moment because everything Saudi has just opened up, so naturally everything is migrating to the new market, especially with Saudi's efforts to, trying to make sure that every company is sort of Saudi made as well. So maybe your question would be more relevant to say, why don't we see, for instance, UAE companies or Jordan-based companies, migrate to Egypt, generally, African countries and North Africa. And I think it comes down to two things: valuations and multiples in that market. So how, yes, it's a big market, but how promising and how much volume are you able to actually get and, translate into dollar signs in these markets? So number one, it's very expensive to go there, maneuver these markets without having really prominent local support. And until you see that dollar sign, I think we've seen that it takes a lot of time for local companies in Africa. So imagine, having companies come from abroad. And I think the second thing goes back to the fragmentation of these markets. So when we look at North Africa, for instance, you have a predominantly French influenced market. So when you look at Morocco, Tunisia, etc. And when you're looking at companies there, and I think this is very specific with my logistics companies that I've worked with, most companies working in these regions tend to migrate to France naturally because language is bringing them together. But you also do have Arabic, in North Africa, for instance, uniting the Middle East and North Africa. But I think that also brings me back to it's a concept of multiples and valuations. And, we might as well make faster money if we expand to Turkey because it's a much more well built out market. It's matured. You have, higher consumer adoption rates. Consumers are aware of the infrastructure. So I think it's better to compare it with a region than Saudi specifically, just given Saudi's, geopolitical and economic state at the moment.
We're still in ENZA. And when I was reading the news, I browsed the websites ENZA and ClearGrid. And ENZA positions itself as a champion of financial inclusion, while ClearGrid takes more of a direct functional approach in its messaging. Both strategies, they have their merits. One appeals to impact-driven investors, but the other focuses on the efficiency and the results. One is more technical, one is more philosophical. As an investor, or maybe a potential client, which approach do you find more compelling?
You talk about impact, and I work in sustainability and with impact-driven companies. So it's a very tricky question. I think impact is very important, but it goes beyond a statement. Both of these companies, the impact they can have based on the problem they are trying to resolve. For example, CleanGrid, they don't seem like an impact-driven company, right? It's very trying to fix the problem of lending and borrowing. But if you look beyond that, right, if you have a more cohesive financial system, the positive impact of that for the country, for the region, for other startups, for SMEs, for everyone in general, it's quite important. So it might not be statement driven, but then you need to look further to what the company is trying to do. There are a lot of statements when it comes to impact sustainability nowadays. I mean, 70% of them really are there just as a marketing, unfortunately, marketing tool rather than really a philosophy for the company. So I think we need to start looking beyond as to what the company is trying to do and how they are trying to do it rather than get stuck in the statements.
Philipe?
I am big on impact investment. Actually, at FTC Angels, we are the Brazil's one and only angel network that invests exclusively on impact startups. So if I were to take your dichotomy, I would, to keep consistency within myself, right? I would need to go for impact, but I don't actually think there's a dichotomy, because I think impact startups, they have beautiful stories to tell, and they should do that because people buy emotions, right? First and foremost, people make decisions based on emotion, then we rationalize our way backwards. But people buy into emotion, but at the end of the day, an impact startup needs to be a company that brings results just like any other company, except that they do that on something that while they're being profitable, they do good. They further important causes that we should all care about. So I don't think there's a dichotomy there. So if I had to choose between, so from my framework, right, from the way that I'm trying to frame this, if I had to choose between a company that delivers great results and it's an impact company versus a company that delivers great results, but it's not an impact company, I would keep the impact company every single time. So just because it's an impact startup, I don't think we should, quote unquote, go easy on the results that they're bringing in, because at the end of the day, this is not a foundation, right? It's a startup, so it needs to make revenue. And the way that it becomes a beautiful story is that it keeps the wheel of the economy turning, because it generates profit by doing good things. Doing good things help them raise more capital, help them bring more customers, and then bring more results. So it's a self-reinforcing cycle, right? And we do look at a lot of self-proclaimed impact startups that they're really just foundations or social projects in disguise. And there's nothing wrong with that, except that they're not startups, right?
Yeah. And I remember back in the days, I don't know if this term is still used or not, Philipe, just correct me if I'm wrong. I think 10 years ago, those companies were called double bottom line companies or funds. Are they still using that, or they replaced that with impact?
I have seen impact much more frequently mentioned than
Okay.
double or triple bottom line. I don't think the triple bottom line idea went away. It's just that I think the planet, people, profit sort of trio is more something you would see in big corporate social responsibility reports that companies release annually, right? The larger Fortune 500 companies. But in the startup world, I'm more used to seeing impact startups and impact investment. And just last year, I'm going to build on that. We had a big impact investor summit in Norway, and I ran a workshop there. And I think the big question that we all wanted, well, not wanted, but had to face, was that the Sustainable Development Goals are as far as ever from coming to fruition. We should, in theory, get to them by 2030, but actually the yearly funding gap is which started around $1 trillion a year, $1.5 trillion back in 2015 when it was created. It's over $4.3 trillion as of mid last year. So the way that we're going to close this gap is impact startups, because then we bring the traditional venture capital money that would not consider itself impact investment and funnel resources into causes that are profitable, but also care about a very important cause.
I think I'm also very aligned with Philipe. I think people definitely, yes, do buy into emotions, and that's the selling point. So just simply put, not thinking startups or VCs. So for instance, when you go and let's say, go into a shopping mall, you want to buy a shirt, and then there's this small box here, and $1 extra is going to go to this foundation, for instance. So you're more inclined to buy from that shop because it's creating an impact somewhere. So I think from a consumer behavior perspective, it's definitely that. But then you also have a lot of investors that say, money, revenues comes first, and then with that revenue, you're able to create impact. So I think it just depends as well on, the investment thesis and how you're wanting to run the show and plug into these companies.
Makes complete sense. Okay, Jamie, you have some exciting news about another AI company, and I'm really excited about this one. So take it away.
Yeah, I'm really excited as well. This is a company I've been bullish on for a long time. I think sort of Incubayt was one of the first startups that came onto my radar when I first started writing for it, about a year and a half ago. So I feel like I have this strange sort of personal affinity for them. I feel like I've been on the journey to a certain extent. And yeah, it kind of pissed me off, I think. I think a couple of weeks back, we had the discourse about DeepSeek and why don't we have a regional AI startup that's, doing it on the global stage? And we do. Incubayt have been doing this for a while now. In terms of who they are, what to do, it's Dubai-based AI dubbing and voice translation platform. And they very, very quietly announced an 11 million pre-Series A. I don't think it's been reported anywhere. It's just something that sort of slid into the very end of a press release, which they released last week. But there's been no sort of formal announcement of this. It's just something that I spotted because I always kind of diligently go through what they release. So look, this brings the total funding to 15.5 million. In terms of investors, it's a lot of repeat investors here: Turtle Ventures, Courtside Ventures, Dubai District Fund, RSA Capital as well, again repeat investor, and Comcast, NBC Sports Tech as well. So look, a lot of strategic investors in play here. Really interesting founding team as well. It's a father and son duo. So it's Avnish and Akshat Prakash. So Avnish, he's the CEO, a lot of experience on the business side. Akshat, a CTO. He did computer science in Carnegie Mellon, worked at Apple, and then sort of segued into the speech and translation AI side of things. So essentially what they built is an AI dubbing engine. So they have clients across sport, film, and entertainment. And the idea is that they're not just localizing content, but they're doing it live and at scale. So instead of kind of your flash kind of robotic translations, essentially enables real-time dubbing that sounds like the original speaker. So I do recommend going to the website or heading to YouTube for examples of this. There's a cool example. They translated Novak Djokovic at the Australian Open. They've dubbed full 2-hour MLS soccer matches in 4 different languages simultaneously. They've partnered with Tennis Australia, IMAX. And then this particular pre-Series A announcement, which I mentioned, was just sort of slid in at the end of a press release for an announcement that they've signed a multi-year partnership with LFP Media, who are the body behind Ligue 1, to give it its proper French pronunciation, which is the Premier League in France, essentially. So they're going to be dubbing broadcasts, interviews, and social content into over 100 different languages and dialects with this particular partnership. And look, there's a really interesting quote as well that Akshat, I can't remember where this came from exactly, but I know it has saved somewhere. In terms of, I guess, their mission, we're talking about the impact side of things. Essentially, the mission to break barriers, technical, linguistic, and geographic. I think he put it, not everybody can become a great artist, but a great artist can come from anywhere. So I do think this is a pretty astute point.
Thank you, Jamie. Well, when I first saw this, I was like, man, we should use this for our own podcast, right? I want to see Jamie speaking in Arabic.
I know, actually, that's a good point. So we should. I'll reach out to Akshat and see what we can do. But I have seen examples of them doing this.
Yeah.
I mean, I don't know whose podcast it was. Some guy, something Huberman, I can't remember his name, Andrew Huberman, something like that. There's a podcast episode, and I just sort of trundle through them going from English to Polish to Chinese, and it's insane. And it really does kind of maintain that the likeness of voice, despite the fact that it's translated. It's crazy.
I wonder how accurate this is because I want to try it with our own podcast in Arabic because I understand Arabic and see how really good or bad this
Yes.
is before we translate it to Chinese and I don't know, Portuguese and other languages and Spanish and see, we can be a multilingual podcast now. So Camp AI is breaking down the language barriers across industries, from sports to media and beyond. And we've seen streaming platforms dub shows into dozens of languages, as just Jamie mentioned. Do you think AI-powered voice localization will become a standard or the new trend for everything from live sports, social media content to startup pitches?
First of all, this freaks me out. I think this is one of the freakiest developments of AI. So, just a funny story. A few weeks ago, I got a call from an international bank. I have an account with them, and I'm speaking to this customer service agent. I mean, very professional, very on point. And then at the end, it says this is an AI customer service machine, and I freaked out. I was about to close my bank account. Like, never again am I speaking to a robot and thinking that that was a real human. So
I mean, that's the future, Sarah. You should get used to it.
No. I want to speak to humans. But
Okay,
anyway,
I understand.
from a venture capital perspective, I think it's just fantastic. I think, what they're doing now and with this news, specifically in sports media and just breaking these language barriers, just imagine how much they can also access international opportunities. So from sponsors to new audiences to new revenue streams, advertisers.
Yeah.
So it's just really breaking barriers, and it's another 10 steps forward to globalization. And I feel like with AI, with natural language processing, everything has just become so seamless. So it's definitely, very promising, and the market does look very promising.
From your comments, Sara, some 15 years ago, I was working to enable LATAM's cloud market, and cloud was still this sort of newish thing. 10 years ago, I was working to bring about LATAM's 5G market, which is just now becoming a reality. And I've been doing AI for, supporting the market development for roughly 10 years now as well. And honestly, I really love Arthur C. Clarke's three I think it's his third law that he says that any sufficiently advanced technology is it's indistinguishable from magic. And I think that's that's one of those scenarios, right? The fact that they can do it real time is super amazing, and they do have very clear cases to explore. Where I have seen resistance is whenever it touches art. So yes, translate my podcast. I have my own podcast, as you know, Ahmad. It's in Portuguese and it's called Fala Nordex. And I bring entrepreneurs and VCs each episode just to talk about basically what we're doing here, right? Trends and their stories and all that. Surely look into that to make it available in other languages. News broadcasting, sports broadcasting, there's a huge market there. But whenever it touches, like, let me translate the short film, then people start to get, a bit more skeptic, or voice actors or actors guilds and actors unions will be like, hey, that's my territory. So as the short-term opportunity, I see tremendous growth. They seem to be using their own model. From their website, I could gather that they do interact with other APIs, but hey, it's perfectly fine as because it's, as I said, it's kind of amazing that they can build this real time. And those were the cases when I was talking about cloud 15 years ago, when I was talking about 5G 10 years ago. Those were the cases that we were going for, right? We want to see things happen at real time, and the huge amounts of processing and energy that go into that, and the data that go into that is really amazing. And I think the future is global. So when the infrastructure is global, the content is local. And I think AI is actually a service, or it's a tool for good to some extent within that framework.
I agree with Philippe and Sara. I mean, I think, the return on ad spend for multilingual campaigns is going to be massive, right? The content is already there. So bottleneck has been the language. Now we are removing that. So this is a Trojan horse. The fact that they've partnered with LFP and, to have an insight and get more deals into sports, media, streaming partnerships. It's great because it also showcase coming from Dubai that, you know, it's not applications with features anymore, is R&D, and we are, you know, doing things better than 11 Labs, for example, which is the other big company in AI for voiceovers and whatnot, but they sound very synthetic. In this case, you have latency, you have scalability, and that emotional nuance that makes it feel very real. And from the investment point of view, having such a sophisticated group of investors, they've landed these big deals at a pre-series A. This feels like a, you know, post-seed stage company that is delivering at Series B level. So it's very strong capital efficiency.
Okay, so here's the tricky question. I know you all, including myself, I'm really in love with this company, and I think it has a potential. But we've seen what happens when LLMs themselves enter any vertical. Just look at AI image creators. OpenAI, just a few days ago, dropped a new model. And suddenly, all of these smaller AI image startups built on top of those models looked outdated just overnight, right? Now, Camp AI is solving a real problem with AI voice localization. But how defensible is this? What would happen if to our investment, if we're VCs and investing in this company, if OpenAI or Google rolled out an ultra-realistic voice localization model? What would happen to all these niche AI startups? Are they becoming obsolete? Are we wasting our money investing in such verticals or niche companies?
I love your question, Ahmad, and I actually, it's something that I discuss here in LATAM very, very often. I think let me take a step back and say there's basically two, or the way that I see it, there's two investment theses for AI. The first is you invest in AI business models, so they're basically consumers of other people's APIs, usually big tech APIs. And they have a niche positioning and they go to market really fast because of that. So they can build fast, they can scale fast, they can also turn around fast if needed. And then the other one is the deep tech investment, which is you're building something from scratch and you might need, or you may not need at some point, to go face to face with, you know, the big techs, which have a lot more money, a lot more engineers, and a lot more cloud capability. I myself am biased towards the deep tech investment, but I don't rule out the other one. So I think what makes a big difference in understanding Camp AI's future is first to understand whether or not they have their own foundational model, whether or not they're sufficiently large data set. So it might not be the case that, let's say, Google or Microsoft close a big deal with them, but if they close TikTok and they're able to dub TikTok videos in real time, hey, you know, that's a sufficiently large immersive video that would give them the data and the robustness to tackle the other players head on. When you have a deep tech in this scenario, another big advantage that they have over the incumbents, well, if I can call them incumbents, right, the big tech players, usually is the cost per token. Because it's not a generalist model, it's made for a single vertical. It can be much more efficient and therefore much more cost efficient. So for me, when I'm looking at investment, and I'd say 60% of my portfolio has AI at some capacity or another, I really try to understand, looking at the long run, if the cost per token makes the model sustainable in the long run. Because ultimately, you could argue that Gemini or Claude or ChatGPT or whomever will be able to go into whichever vertical you want. But number one, they might not be as cost effective, and number two, they might not be as assertive because they are generalist models, and you always risk some hallucination and loss of context and all that when you're looking at sufficiently large context windows. So I don't have those answers for Camp AI, but those are the things that I would be looking for as an investor.
Yeah, makes sense. Makes sense. Cristina?
Yeah, I agree with Philippe. I think being specific when it comes to the development and knowing what you're trying to do so you differentiate yourself in a way, it's key. But as well, being devil's advocate at the rate the technology is changing, how many players we have globally. I think as investors, we need to recognize that that's the risk you're taking. And either you're comfortable taking the risk and you understand what you're doing and where you're getting into, right? Or you're not. If you're not, then, go invest in something else because it's probably not going to go your way. So you need to think as well about what is the level of confidence that you've got in the investment, in the founders, in the tech, and be aware of the risks because yeah, chat GPT itself got kind of kicked, when DeepSeek came along and it was just, out of the blue. So is I think is the nature of the beast, but it's as well what is going to take the AI industry and these models to a level where there is a stability in the market. There is not so much competition coming in, and we find that plateau moment obviously is not going to happen tomorrow, but in the next 2 5 years we'll eventually get there, and is by increasing competitions and having people
Yeah.
developing better models every single time.
Yeah.
I've seen that happen, by the way, your question. I've seen it happen twice with
Yeah.
Brazilian startups that were, and I was actually helping through the due diligence and the deal flow process of one of them as a potential investor. And I was the first to flag, hey, this is such a great idea, but this is at such high risk of disruption by the very platform that whose API they are consuming. And wouldn't you believe that we are 2 weeks into the due diligence, and then said API company actually created a change in their terms of service, and overnight, and I kid you not, this was a Thursday, and on the Friday, the company had no reason to exist anymore. So, and they
Wow.
were at pre-seed, but they had already raised roughly $1 million. All that money down the drain, like instantly.
The acceleration of new technology coming up will force VCs to somehow change the model or tweak the VC model itself, right? I don't know how, but I think something will happen because this is not viable anymore. If I'm investing in a company today and I have like a 5 to 10 year, vision for that company, but then within 2 years, as you mentioned, overnight, the company is obsolete. I mean, this doesn't make sense anymore. I don't know how, but we need to think about maybe new ways to do venture investing in the AI era. One last question about this company. So Camp AI is a Dubai-based company, and clearly it's a global startup from day one, working with major international sports and media companies. Great job by the founders. And so exciting. And what's even more exciting is that we have a father-son duo on this company. The father is the CEO, the son is the CTO. This is very rare in venture-backed startup. As a VC, would you see this as a strength or a potential risk? And in general, what are your reactions to having a father-son co-founder team?
So, Ahmad, as to your question, I think the first thing that I would look for is I would try to consciously. I know it's a hard, because we all have biases, right? It's hard to disentangle this, but the first thing that I would ask myself is, are they, as founders, are their skills complementary? Do they make sense in the balance? Do they have what I would expect from a balanced founding team? And if that is the first check, then absolutely, let's go ahead. The second is, I think there's a lot of really good literature and practice on governance of family-owned businesses. So while that does seem to be unorthodox for our venture capital slash startup scenario, on the more traditional side of companies, it's a very common issue. And I think there's good practices that we can all learn from. And as long as we can, as advisors and investors, and we can look for those cues, and we can look for those patterns and help them move in productive ways, then I think it's even an advantage that they can have in their favor because of how of well, first of all, they cannot divorce their founding
Yeah.
partner, right? Just like, no, I don't want to do business with you. Let's go our separate ways. That's going to be hard. It's not impossible, but that's going to be hard. So they have that we need to stick together and make it work kind of vibe. But as long as we can take some of those best governance practices in from the start, I think it's a tremendous advantage.
Yeah, I think it's very nuanced, as Philip was saying. That's why I was offering very selfishly for him to answer the question first. Because as much as you can employ logic and you look for the nuances and the cues and you advise and run your checks, as in any company, right? At the end of the day, you need to really weigh what's the probability of that relationship going sour. I don't know these people, but I'd imagine, if they are getting into a business together, they have a sort of strong relationship they can count on. So I think that's, for me, yes, I would invest, and I think it's not necessarily a bad signal, but of course it is a case to case, because I think it was Tolstoy that used to say every single family is unhappy in their own single way, something like that. So,
Yeah.
you gotta look deeper into what the relationship between them is, but it doesn't necessarily mean it's a bad idea.
Yeah, and I think we've seen that in multiple other cases, like, for example, in family offices or in traditional businesses, when they become big holding companies, we have the father and son and daughter and the family businesses becoming corporations, and then they introduce some structure. But that happens naturally. In a startup, it's a bit different because they're both co-founders and they're VCs trying to influence maybe sometimes the directions of the company, and both of them have visions for their own baby. It's like they both have a baby together, this company, this product, right? And how would that dynamic work out between the father and the son? I don't know. Well, maybe we'll host them sometime in the future.
That's why I think looking into that relationship is so important, because if they are a united front, as they should be, right? Obviously, they're going to have disagreements, as in any relationship. That would probably account for a higher success rate of the company and a better direction, hence better results.
If they fight, I hope this will not affect the relationship as a father and son. And
Indeed.
yeah, exactly. Before we wrap up, a big thanks to OCTA for sponsoring today's episode.
If you want to get paid faster, access financing, and automate your receivable process, head to weareocta.com. That is weareocta.com, and take control of your accounts receivable today.
With that, thank you so much for joining us today, Cristina, Philipe, and Sara. We would love to have you soon again.
We'd love to attend
thanks
again.
so much, guys.
Yeah, man.
Jamie, as always, thank you so much for bringing us all this news every week from FWDstart. Thank you.